Good afternoon. Welcome to Markets Today. I'm Reema Tendulkar and these are the headlines for the day. Sensex slips nearly 250 points. The Nifty loses 60 points despite an intraday recovery. Crude oil prices eased from two-week highs after United States loosens sanctions on Venezuela. Cement major UltraTech meets estimates in the second quarter. Revenue rises 15% as power and fuel expenses remain in check. The company says capacity expansion plan is progressing as per schedule. Big FMCG results. Hindustan Unilever reports a steady second quarter. Profits and revenue grow at nearly 4%. Margins cross 24%, beating estimates. Nestle India's third quarter earnings largely in line. Profits up 37% on a yearly basis, aided by a one-time gain of over 100 crores. Bajaj Auto is the top Nifty gainer on a healthy second quarter, reports a 20% jump in profits. EBITDA crosses 2,000 crore rupees for the first time ever. Margins almost near 20%, beating estimates. PVR Inox recovers from lows after optimistic management commentary for the second quarter. LTI Mindtree gains on posting better than expected margins and they see improvement in growth ahead. WHRO slides after reports a weak second quarter, guides for a weaker third quarter. And here's a lineup of what we have for you in store today. It's a packed show in Market Opinion. We've got Tahir Badshah, CIO, Invesco Mutual Fund. In Big Corporate Voices, Ajay Bijli, Managing Director, PVR Inox, Nachiket Pandey of LTI Mindtree. On to the day's trading action then. Markets failed to hold on to that intraday recovery. The Sensex slipped 250 points, Nifty down 60 points. Bajaj Auto was the top Nifty gainer after reporting healthy numbers in the second quarter. Surbhi's here with a wrap of the day's trading action. Surbhi.
Well, an out-and-out risk-off day today, and that was very evident no matter which global screen you were looking at. Asian markets were down almost 1 to 2%. Japan, Hong Kong, many of these markets nursing big losses. While we were trading, Europe was down between 1% and 1.5%. And those bond yields in the US, they are relentless with the US 10-year almost at the 5% mark. So against that backdrop, you look at our performance and maybe it's not too bad because the Nifty did end with a cut of just 0.3%. There was a good recovery from the morning opening lows. The market couldn't exactly retain a lot of that recovery, but nonetheless, as I said, the losses weren't too steep, and that's something to take away on the positive side. We had some good earnings reactions coming in, particularly on the Nifty, and that at least kept the mood fairly cheerful, not entirely gloom and doom. Bajaj Auto 7% after a phenomenal rise in the EBITDA margin, the EBITDA profile. LTI Mindtree has been the best result reaction from the IT space. Nestle's numbers and its stock split in particular was quite well received by the market, and UltraTech Cement hit the spot as well. Coming to some weak earnings reactions, WHRO. Now, it's very clear the market is not going to be in a forgiving mood wherever there is a guidance cut or extreme weak commentary, and that was WHRO down 3%, and Bandhan Bank completely missing the point when it came to asset quality. What were the key drags on the Nifty? Some banking names, ICICI Bank, HDFC Bank, Kotak, and TCS and Reliance. These were the big boys that were taking the index down. Mid-cap IT was very interesting. Some of these companies are seeing a lot of buying. Persistent, for instance, after the numbers. There was Cyient, there was Newgen Software. So mid-cap IT is where some bottom fishing is definitely going on. Aside of that, some interesting stocks in news. NBCC was soaring higher, good price and volume action there. Astral reacted negatively to what looked like an okay set of numbers. And IGL down 5% because there are fears that it could lose some volumes in the Delhi market if there is a quick move to electric vehicles. Well, there's a lot to look forward to tonight, largely on the macros, because the markets are going to eye Fed Chair Powell's speech at the New York Economic Club very, very carefully. Those bond deals are going to be the key watch point when we come back tomorrow.
Thank you very much for that. In Market Opinion, Tahir Badshah, CIO, Invesco Mutual Fund, is seeing opportunities in pharma, real estate. He also said there seems to be some pushback in IT companies. Earlier, everyone was anticipating demand to improve. Now they're saying that expectation is pushed back by at least 1 quarter in FY25.
Specific export-related opportunities which are coming through in certain consumer kind of products. So I think it's a pretty diverse, eclectic mix of different opportunities. There are certain companies which are in the pharmaceutical space. Of late, even some of the real estate opportunities have come into focus. More importantly, they operate in the premium to the luxury segment of the market. I think those are the spaces that we are trying to look at, and that is where some of the incremental opportunities are coming through. There seems to be a certain amount of pushback for sure. I mean, there is business which is coming through, but it is not starting to ramp up or it is not starting to execute. And this is pretty much the trend across all the kind of companies. We've seen that, right? So I think it does push back the expected recovery in growth for FY25, maybe by a quarter or so. And to that extent, I think some of the rally which has happened in the recent times also puts them at a stage where valuations don't now necessarily, offer a lot of upside.
Okay, that's the opinion coming in from Tahir Badshah. Let's get on then and talk about some of the the second headline for the day. Cement giant UltraTech second quarter numbers were largely in line with street expectations. The company's net profit rose by nearly 69%. Revenues were up 15% annually. The stock was up 2.9% post the reactions. Nigel joins in with the key highlights from the numbers. Nigel.
Well, UltraTech's numbers actually were in line with what the street was working with, but the much feared negative surprise didn't come about. And I think that's the reason the street liked it. So let's run you through the numbers. First, if you look at the top line, the EBITDA, as well as the profitability, it's pretty much in line with the poll that we threw up. On a year-on-year basis, there was a growth of close to around 15%, and entirely that was because of higher volumes, which we already have with us. The margins, well, they came in at close to around 16%, which we were working with, which meant there was an improvement of close to around 250 basis points odd. The power and fuel costs were up only around 2%, though other expenditure did spike up by close to around 14%. Higher maintenance costs and higher employee costs did play its role out there, while the net profit number was up close to around 70%. The reason that those margins did expand is because of two factors. The logistics cost and the energy cost, both of them did decline, and they constitute close to around 60% of the total cost basket. The blended fuel consumption cost as well did come down to around $162 per ton, which is quite good in comparison to year-on-year as well as a sequential basis. The net debt increased, but that's on expected lines because of the heavy capex that they've undertaken. The commentary from the management, though, was fairly positive. So all in all, no negative surprise, positive commentary. The street is optimistic on the prospects for the second half of the year.
Thank you. Let's get to the third headline and more earnings. FMCG giant HUL reported a steady Q2. The company's bottom line beat estimates. Revenue volume growth was a minor miss. Mangalam is here to decode the HUL second quarter numbers.
For the second quarter, Hindustan Unilever reported a strong operational performance. Well, on the top line, it was a mild miss, but given the current environment, the street would take that. What really stands out from the numbers this time around is a sharp 700 basis points gross margin expansion that the company has reported. That's nearly 2 times the expectation, the average expectation on the street in terms of an expansion. Most were working with a number of around 300 to 350 basis points as well. That's not all. The EBITDA has actually grown above street expectations. The company has reported an EBITDA of close to 3,700 crores. The street was working with a number of 3,600 crores itself. And this is despite the company plowing back some of those gross margin expansions into ad spends. For instance, earlier, the same time last quarter, the company spent only 7% of its sales on advertisements, but now they've ramped that up by 65% year on year and have gone up to 11% of their sales on ad spends itself. That's telling you that they are putting their money behind their brands, and competitive intensity is high as well. And that's where the real softness comes in as well. The volumes grew by just about 2%. The street was working with a number of 3 to 4% as well. And in that, the management sees gradual recovery in the rural business along with high competitive intensity. They do expect some improvement coming in the near few quarters, largely on account of the festive season and gradual normalization in the FMCG sector as well. But by and large, these are a steady set of numbers, strong operational performance, and in light of the underperformance that we've seen in the stock, expected to do well in tomorrow's trading session.
Thank you for that. My colleague Shilpa Ranipeta caught up with the management after the result. Here's what they have to say.
We hope when we've gone through this whole cycle of inflation, deflation, and we're more in the steady rate, we should be looking at our mix of 50-50 volume value growth, and we go back to our traditional sort of CAGR of 8-9% that we've had in the last decade. So we're doing the right things for the medium to long term, and we're quite certain that given the fundamentals of the business are strong, that the competitive volume growths will come back, and we're very, very focused on that as a one single-minded mission for the entire company end-to-end at this point of time.
As you know, in this quarter, we had roughly flat price growth. And our view going forward, Shilpa, is if commodities remain where they are, we would see, in fact, marginally negative price growth in short term. So that's the pricing outlook given where the commodities are at this point in time. Of course, on a long-term basis, commodities are cyclical, which means what has come down will go up, what's gone up will come down, and it will stabilize. And on a long-term basis, to Rohit's earlier point, we do see FMCG growth roughly 50-50, where we expect half the market growth indeed to come from price and half should come from volume.
Okay, let's get back to Manglam because Nestle reported the Q2 numbers. The stock surged nearly 4%. The results were largely in line with expectations. The bottom line was up 37%. But this was aided by a one-time gain of 106 crore. Sources have told CNBC-TV18 that the company's domestic volume growth was at 4%, which is slightly lower than CNBC-TV18's estimates. Manglam's back with us for number crunching the Nestle's numbers.
Good going for Nestle. In fact, strong gross margin improvement is what stands out this time around for them. The stock hitting a fresh record high as well. That's not all. The 1:10 stock split that the company has announced as well is something that the street likes. Most would have expected, 1:5, etc., because the face value was 10 itself. And to add to that, the company's EBITDA margins have also expanded by a good 70 to 80 basis points. If you just take a look at it, the revenues crossed that 5,000 crore mark, 5,037 crores compared to street expectations of 5,142. That's a mild miss, but I'll tell you why the street is not worried about that. The EBITDA coming in at 1,224 crores. The street was working with a number of a little over 1,200 crores. And the net profit came in at 908 crores versus expectations of 805 crores. The other 100 crores came in on account of an exceptional gain. Now, the domestic volumes grew by about 4%. Again, in line with, largely in line with expectations of 5 to 7%, mildly below out there. Domestic revenue growing 9%. At the same time, the export revenue, which is about 5% of their revenue, that dipped 6.5% versus expectations of 12 to 15% growth. And that's where largely the miss on the revenue has been. So nothing really to worry about. The gross margins, they've expanded by about 370 basis points versus street expectations of 80 to 100 basis points itself. And as a result of which, the EBITDA margins have jumped 220 basis points year on year. And the companies increased their ad spends. Despite that, we've seen a big jump in the EBITDA itself. The management said that domestic sales have actually grown double digit on account of mixed volume and price. E-commerce is doing well for them as well. And going forward, because of the healthy milk flush season, they will see further deterioration in milk prices, which is good for them because that means that the margin expansion that the company has reported this time around is likely to continue for the next few quarters. And the second half, obviously, we will see a better sales mix as well on account of festive season. So all these things in the near future look good for them, as a result of which the stock doing better.
Thank you for that. Get into a break, but stay tuned. We'll be back in a jiffy with the other headlines. Welcome back. You're still with us on Markets Today, and let's go to the rest of the headlines that we're tracking for you. The fourth one, Bajaj Auto rallied 6.5% after reporting operationally strong margins in the second quarter. The company's EBITDA crossed the 2,000 rupee mark for the first time ever. EBITDA margins have come in at 19.9%, so almost at the 20% band. Sonal is here with the key number. Sonal.
Thank you so much for that. Well, yes, it was a good set reported by Bajaj Auto. It was operationally better than what the street was working with, and that's what the street likes as well. Margins were up 260 basis points on a YOY basis, better than the estimates of 19.3%. Margin growth this time was driven by better realization and a richer product mix as well, something that the management told us as well in the morning. Quarterly EBITDA surpassed the 2,000 crore mark for the first time ever, and revenue growth came in single digits. This despite the fact that there was an 8% volume decline this time, and it meant that it was driven by price hikes that the company took this time. So overall, revenue growth of 5.6%, EBITDA grew by 20%. There was an operating profit margin expansion of 260 basis points, leading to a profit growth of 20%. Now, there has been a strong cash generation as well. If you look at the balance sheet, their free cash flow came in at 3,600 crore rupees, up 1.6 times versus the 1 year ago. And brokerages, they are sanguine on the stock. Jefferies has raised the target price to 6,000 rupees a share. They maintain the buy rating. And we have Morgan Stanley, which has an overweight rating with a target price of 5,449 on the stock. The stock is surging in trade today.
The mix has really improved in favor of the premium motorcycles in the domestic business, a surging three-wheeler business, and because of some exchange rate improvements, realization improvements between Q2 of last year and this year. So that's what has sort of driven the margin improvement. Yes, we are dancing around the 20% mark, and it is true that the commodities are soft right now. The market share at an overall level in the domestic motorcycles business has gained a couple of percentage points between Q2 of last year and this one in retail terms.
Okay, moving on to some other stock-related stories. Dabur shares fell in trade after it announced 3 of its subsidiaries are being sued in the United States and Canada. Consumers have alleged that the company's hair products have caused ovarian cancer and uterine cancer. Dabur also informed the exchanges that 3 subsidiaries have denied liability as these allegations are based on unsubstantiated and incomplete study. And here is the 5th headline for the... Okay, let's move on then to the 5th headline for the day. PVR Inox reported its best ever quarter in the July to September period. This is on the back of a strong performance of, blockbusters like Jawan, Gaddar 2. The multiplex chain's net profits came in at 166 rupees, which compares with a loss of 82 crore in the previous quarter. Revenues have come in at 2,000 crore rupees. The management said the company is focusing on turning free cash flow positive this fiscal. They also added that even mid-size movies have done well this time around.
I think the second big thing which has happened for us is because the quarter was very strong with healthy cash flows. Our focus is to also, turn free cash flow positive this year. Our first 6 months have been free cash flow positive after our capex spends. Our average occupancy in this quarter was about 32%, which is similar to what we did in 1920 PVR Inox combined in a pre-COVID era. And our margins this quarter are roughly about 22% versus 18% that we had in 1920.
Last year, this quarter wasn't good at all. People were still skeptical about coming out. Movies, I would still say, were not so bad, but yet I think there was still some circumspection from a certain segment of the customers to come out and entertain themselves on the big screen. All that is over now. And now people have come out. We've had blockbusters doing well, and we've also had mid-sized movies doing well, Hindi especially, and also regional and also Hollywood. So all sorts of movies, the way they used to work pre-COVID, have worked now as well. So it's very heartening to see that.
LTI Mindtree rallied close to 6%. The company reported a net profit of 1,160 crore, slightly above expectations of 1,130. Revenues were in line with street expectations, but the EBITDA performance was a bit of a beat. The company reported an EBITDA of 16%, which is lower compared to 16.6% that they reported in the prior quarter. The decline in margins was on account of wage hikes, but it's still a better showing compared to what the street was anticipating, and that fueled this big 6% rally that we had in the stock. We chatted with Deshpande, the COO of the company, who said that the order inflows have been steady. He also added that they will exit this fiscal with a margin of 17 to 18%.
As you see in our order inflow numbers, we've been steadily having healthy order inflows for last quarter as well as this quarter. And that's really how it reflects going forward as well. We don't expect any spike in that, but we expect that we'll continue to have the steady build out of that order inflow as well as more deals come close. Also, of course, the deals that are there now, more number of deals are cost takeout, cost efficiency, consolidation oriented, right? Which will mean that they tend to be more, longer tenure deals than the transformation deals. And that, from that sense, you will see an increase in the TCV, and you might see increase in the order inflow accordingly. As a combined company, we will exit with the margin that we were used to deliver. Our margin optimization initiative that we launched post the merger is delivering us results and is expected to deliver all of its savings in Q3, Q4. We've also managed to take utilization to 86% plus, and we are confident that we'll be able to maintain at that utilization.
While LTI Mindtree did well, WHRO didn't have any such luck. WHRO was one of the big losers in today's trade. This is after delivering a subdued performance in the second quarter. The problem is their Q2 revenues declined by 2%, and their guidance for Q3 was also weak, with the company saying revenues will fall by 3.5% to 1.5% in the October to December period. Thierry Delaporte, CEO of the company, said that the market continues to be difficult over the past few weeks. They said that clients are being very cautious about the discretionary spend. On the subject of margins, they guided that margins will remain range-bound and the salary increment will be rolled out from 1st of December.
The revenue has been, at a little lower than expected. And, while in the guidance still, the reality has been that, the market has continued to be a little, difficult over the last few weeks. We have seen, same volume of reduction of discretionary than, a little more than what I would have anticipated.
We did indicate that our margins will remain range-bound in line with what we have delivered over the past few quarters. There is a salary increase which will be rolled out effective 1st December. So we will have 1 month impact of those salary wage hikes. And in Q4, we will have 2 incremental months compared to Q3. How much and the quantum, it'll all depend, but it is likely to remain in the same range as what we've done.
We have not onboarded freshers in H1. We had made offers last year, and we need to onboard them as the market improves. So far, we have not onboarded freshers in this year.
In more earnings, Coforge was buzzing in trade after reporting a mixed bag. Net profits lower than expectations at 180 crore. The street was anticipating a profit number of more than 200 crore rupees. Margins too came in slightly lower than what the street was anticipating, but the revenue growth met the street expectation. The company has maintained its constant currency revenue growth guidance for the year at 13 to 16%. In global earnings, Finnish mobile manufacturing giant Nokia has plans to slash its workforce by 16% by 2026 after reporting a 69% drop in the profits. Roughly 14,000 jobs will be affected globally. The company says this move will help the company reduce employee expenses by 10 to 15%. The company also expects to save more than $400 million in 2024 and around $1.3 billion by 2026. Tesla reported a weak set of numbers in Q3. It missed street expectations on both earnings and revenues for the first time since the second quarter of 2019. Revenues came in at a little more than $23 billion. Earnings per share was at 66 cents. Operating margins fell significantly from a year ago. CEO Elon Musk cautioned that Tesla's Cybertruck won't deliver significant positive cash flow for more than a year after production commences. And with that, it's a wrap on this edition of Markets Today. Stay tuned for more news and updates.